Hello everyone and welcome to John's retirement video for the month of December. So this is going to be the full year review. We're going to go over some numbers for income, balances, look at the account history over the last 6 years, and some other items as well. But I think there's going to be some interesting insights that you can take away. And let's jump into the numbers. So, as always, I'm not a financial advisor. I don't claim to be one. And this video does not reflect the views or opinions of my employer. I do hold a number of positions in similarity with John and Jane, and I do have the ones listed for John on the screen here for his retirement portfolio. It is a real portfolio with actual shares being traded. It's not a practice portfolio, and that's why I include so many screenshots to show the validity of what it is that I'm doing, so that everyone knows that it's not fake. I've mentioned this a few times. I am going to be making a video to make sure that I don't have to cover this section in the next section again, because the why I do this really goes back to John and Jane were being taken advantage of, in my opinion, and we saw them hit with a bunch of fees that they shouldn't have had to pay, and things weren't disclosed very well to them. So really, after some years of becoming friends with John and Jane, they decided that they wanted to take their retirement into their own hands, and that's just kind of where I came in. So I just asked that I be able to make some videos, and in this case, I had started with articles, but to be able to help other people that maybe don't have someone like me in exchange for doing this. So I don't get paid anything by John and Jane. I just do it because it's something I'm really passionate about. And for the background, John and Jane are both retired. They do collect Social Security, but then they also collect $1,700 a month currently from their taxable portfolio, and then $1,000 a month from John's retirement portfolio. They do have other investments outside of what I help them with, primarily low-risk investments. And then also they have no debt or monthly payments, so they make my job extremely easy because they live a very moderated life in terms of they own all the things that they have outright, and they're very good about living within their means. So for the headlines, the traditional IRA generated just under $2,085 of dividend and interest income for December of 2023, and that compares with just under $238 of income in December of 2022. The Roth IRA generated $1,071 of dividend and interest income in December of 2023, and that compares with just under $940 of income in December of 2022. The traditional IRA also ended with a balance that was just $1,000 under what it was in December of 2022, so that was pretty good, and we'll get into that number a little bit more. But the Roth IRA ended considerably over the amount that was ended with in December of 2022, just under $16,000 higher balance in the Roth IRA than it was the previous year. There's only one company in this John's account that offered a raise or a dividend increase during the month of December, and no companies decreased their payouts in December. So for the increase, that came from Maine. That came in the form of a increase as well as a supplemental or special dividend. So that's something that's been covered in Jane's video as well, if you guys have watched that. I like to show the position that exists for the companies that raise. I think it's just an interesting way to kind of look at the position in the portfolio. And so Maine contributes a significant amount of income to John's retirement account. So in this case, since January of 2020, it's contributed $4,673.44. And then the position, which has existed now for quite some time, it's set to generate just under $1,200 of dividend income annually, but that does exclude the special dividend. So part of the reason why the income produced over a 3-year period, or sorry, technically a 4-year period, is as high as it is in part because of the special dividend that is consistently paid out, even though the position has been built up over a couple of years here. So just something to be aware of as to why this number isn't even higher, is because it's also looking at the fact that not the entire position was established by that point in time. For the trades in the account, we did add some more shares of Healthcare Realty. Things look to be kind of on the mend with Healthcare Realty in terms of the turnaround in the share price. So I'm willing to build up a lower cost position here with the hopes that we can kind of trim back the higher cost shares at a later point in time. With Lowe's, we did recently purchase shares at just under $190 a share. We did set a limit trade for about $225. And that was to cut back some of the shares. Basically with Lowe's, when it gets over about $220, $225-ish, that's when we tend to trim it back again, because it's just, at that point, to me, it's overvalued. And then for Charles Schwab, the money market, $15,000 was moved into it. Main reason here is going to be that there's just not a lot of buying opportunities. The market's become pretty richly valued, in my opinion, in many cases overvalued. And so moving that money into the money market so that it can actually accrue some interest was in John and Jane's best interest. And then for the Roth IRA, we added to the Truist Financial position. They recently did get an upgrade by analysts, so that's something where they also look to be on the mend in terms of their share price moving in the right direction. And then the other three sales, one was going to be for Apple Hospitality. That is going to be the high cost position that I've mentioned in a previous video. And we reduced that position simply because it was the highest cost shares. We would be looking to add more shares of Apple Hospitality, but it would have to be under probably about $16 a share for us to be interested. And then for Essex Property Trust, that was the reduction of the high cost share position with Essex, and then also with Prologis, those 15 shares represented the high cost position for that stock. And then for the gain loss, so in the traditional IRA, the Bank of California one was actually from the conversion of PacWest Bank Corp shares over to Bank of California. So that's basically 38%, I guess, of one share. And so basically they ended up doing a payout on it so that we didn't end with a fractional share. And then, as I mentioned, the Lowe's sale here, that had a cost basis, I believe it was exactly $190. Actually, we can see that right here. And so a pretty good takeaway from that. So we still have 30 shares in Lowe's. We'd be looking at adding more shares to Lowe's, but it would need to drop considerably. Usually the buy point for us is about $190 a share. And then for the Roth IRA, Essex Property Trust, as I mentioned here, very close to the cost basis, basically $20 here for the loss on that. Prologis, pretty much at a break even, and then for Apple Hospitality, pretty much at a break even as well. So on here, I think the most helpful way I've been looking at this page is that the gain loss ratio, for every dollar of shares sold, 88.7% of the time, it's resulting in a gain. Is kind of the way that I tend to look at that. So one of the reasons why I think that's important is because if this number was lower, if it was, say, 50%, for example, what it would mean is that we'd expect to see a net gain of basically zero, because we'd be saying that the number of times that we're selling at a gain is equal to the number of times that we're selling at a loss, resulting in a net gain of 0. And why that matters to everyone watching these videos is that if, for instance, you saw that there was a ton of losses being taken, and not many gains being taken, it's possible that someone could be selling off all their losers in order to make it look like the ones that they kept, that their portfolio is somehow performing better than it really is. And if you remember, if you've been watching these videos, I've mentioned this previously, but part of the reason why I give so much information in these videos is my goal is to make it so that it can't be faked, or it can't be something where I try to make it appear better than it really is, because giving you access to a lot of the data points that I have actually makes it to where it would be very difficult for me to try and convince someone that things are going better than they really are. So again, just real quick, with the gain loss ratio being up above 80% like this, that just means that what we're selling off ends up resulting in primarily gains over losses. And then for the year-over-year comparison, the differences here are going to be that we added Intercontinental Exchange to the portfolio. We did decrease the holdings in Aflac, Stag Realty, and then also Valero Energy. There was also the merger of Umpqua and Columbia Bank. It now reports under the ticker symbol of Columbia, so COLB, even though the name of the bank is still represented as Umpqua Bank. And then another note, I think that for the Charles Schwab money market and then CD income, it does represent a modest shift where the income is coming from. And so moving forward, that's going to be something that is a big differentiator in terms of how much income is being generated by these types of investments. And then for the Roth IRA, as mentioned, so the Apple Realty dividends continued to grow after it was reduced significantly in the aftermath of 2020. But the overall decrease in the position was because of the sale of the 100 shares. We did eliminate PNW and then also SWX from the portfolio. SWX in particular, a lot of things going on there, became significantly more volatile. Also, a lot of activist investors, I believe it's Carl Icahn, was getting involved in some disputes there. And so, frankly, for the yield that was presented, it just didn't make sense to hold it in the portfolio anymore. And then for PNW, we had purchased shares at a extremely low point after some negative regulatory news, and then after that regulatory news was resolved, the stock price increased pretty significantly, and we decided to exit out of the position then. And then for Prologis, so PLD, and then TFC, Truist Financial, we increased, added PLD, but increased the size of Truist. And then CD income, similar to the traditional IRA, is now set to be a regular source of income moving forward. So here's where I think some comparisons get really interesting. So basically, in the month of November, we were estimating that it was going to be a negative 6.3% income year over year, and it ended up actually only being negative 4.4%. And so basically, the income expected in the month of December was considerably less than what was actually received. A lot of that is going to be coming from the CD income. There was also a rather large increase in income in the Roth IRA, which was up from 16.7% in November and ended with a final 18.1% increase year over year, which is very substantial. And we'll look at those numbers a little bit more in depth when we look at the timeline of 6 years. And then as far as the combined average monthly income, I think so. This is combining the traditional and the Roth IRA. Portfolio income on average in 2022 was just under $2,200 a month, and then in 2023 the amount of income produced ended up at just under $2,260 a month on average. And then for the account balances, I mentioned previously that the traditional IRA is down $1,000 year over year. But the Roth IRA balances are at the highest level that they've been since July of 2022. Excuse me. And so that's something that is pretty substantial and nice to see. But even with the market rally, account balances are still lower on average than 2022 for both accounts. So that's looking at these average balances here at the bottom of these images. And I think a big reason here is that we just see a lot more volatility in 2023 in terms of the lows are lower and the highs are basically, I shouldn't say just as high, but there's a higher variance here towards the low side versus with 2022, there's a high variance, but it's toward the higher side numbers. And that's part of why there's a big discrepancy here. Now, if we were to add back in the $12,000 of cash withdrawals taken from January 1st through December 31st, it would reduce the difference in the traditional IRA from negative $1,000 year over year to a positive $11,000 year over year if added back in. So that is a big positive there, is that with these account balance numbers, it is not factoring in the funds that were taken out as withdrawals. So for the traditional IRA, I've mentioned this in previous videos, but when it came to the income produced in 2022, the month of July saw a very substantial increase, and the bulk of that, I shouldn't even say the bulk of that, but basically that increase comes from a $2,400 special dividend from when Healthcare Realty acquired Healthcare Trust of America. And then, so if we backed this off, we would end up seeing dividends in 2022 of $15,427.52. That means that this would have resulted in a year-over increase of about 9.4% in 2023. Had we used the 15,427.52 as the number instead of the 17,827. But even if we average in the negative growth here, we're still looking at a cost of average goods returned of about 15.3% since inception. Now, that number is going to be a little bit rosier, and the reason in part why is because, remember, 2018 was the first year that this portfolio was established. So I think it's worth noting that the 15.3% is something where it's on the more generous side of things. If you were to actually consider it, I would say use 2019 starting from there to get a true idea of how much the dividends have increased over the years. And then for the Roth IRA, 2020 and 2021 were setback years due to COVID related and dividend cuts. Every company has increased, or I should say at least reinstated, some form of a dividend payment, even if it's not quite as high as it was before. But it is possible that we will see the income double. I think that's going to be kind of a long shot unless it pulls another 2022 type of increase year for the income. So overall, though, income has grown at a cost of average goods returned of 12.8% since inception, and that's even with the setbacks seen in 2020 and 2021. So the potential for income to grow is very substantial in the Roth IRA. So for the cash balances, we don't reflect the CDs and money markets in the cash balances, even though they are basically what you would consider to be cash-esque investments. But John currently has $45,000 in CDs, $30,000 in Charles Schwab money market, and then another $38,000 of cash on the sidelines as of January 4th, 2024. But there's a delay between cash on hands in the tables as compared to the second bullet point. So also remember that these cash on hands, this cash on hand is represented by the end of month numbers. And then for the unrealized gain loss comparison, we're sitting about flat in both accounts, generally speaking. But for additional perspective on volatility, I found it interesting that 5 out of 12 months were in the red in the traditional IRA, and 10 out of 12 months were in the red for the Roth IRA. Even with this volatility, both accounts saw increases year over year in income generated, especially once we account for the $2,400 special dividend in the traditional IRA that was received in 2022. So even though we saw more in the red here, we still saw income increase, and that is why I emphasize that income increasing is the most important component of your portfolio, even if the investment value of your investment is volatile. And then as far as the traditional IRA withdrawals go, so John is elected to receive $1,000 a month, even though the traditional IRA actually was able to generate about $1,420 a month worth of income. John, as I mentioned previously, they found a way to live on less income than what their portfolio produces, and that definitely has made my job significantly more easy, but also makes it so that it prolongs how long the portfolio can offer income, even though there's going to be a required minimum distribution in place. In the next videos, I will be discussing the RMD a little bit more for 2024 because John notified me of how much that is going to be moving forward. So, excluding the $2,400 special dividend in 2022, John could have drawn $1,285.63 and remained cash flow positive from 2022 to 2023. And cash flow from 2022 to 2023 increased by nearly $135 a month once we've removed that $2,400 special dividend that was received. So for the current gain loss, I've always mentioned it's the most important table. Current yield is sitting at 4.88%. The three positions that are currently the most underwater are Bank of California, Healthcare Realty, and then Altria. And then Valero, Chevron, and then Duke Energy represent the highest potential for capital gains. And then for the Roth IRA, numbers were updated also on January 3rd. Current yields at 4.62%. The underwater positions, or at least I should say the most underwater positions currently are Dominion Energy, EPR, Realty, and then also T. Rowe Price. But the positions that represent the highest potential for capital gains are Iron Mountain, Pepsi, and then Brixmor. So on the conclusion here, market continues with its unwarranted rally. Shouldn't be any surprises here for anyone who's watched these videos before. But I did find it interesting that there is now even speculation that interest rates could increase before they actually end up being cut. So that the introduction of some of these ideas, I think, is part of what's contributing to a more volatile market. But key issues around whether or not rates are going up or coming down are rooted in employment rates, inflation, and inflation. Inflation begins to move lower than when there are fewer people able to purchase those goods. Great example is going to be the auto market. And a rising unemployment rate reinforces this because it represents potential buyers that would have potentially had the means but no longer have an income to be able to afford those items. So, I'm not saying that I expect rates to rise, but I also don't expect rates to come down. I just think that the market is being too optimistic about how fast this is going to happen. So anyway, I think that there's some interesting things going on when it comes to inflation, how they report it, whether or not it's doing well or it's not doing well. And in this case, the best example I saw was that in healthcare, the cost of healthcare has gone down like 25%. But the reality is that people are actually changing the plans that they have to a less expensive one because they can no longer afford the types of increases that have been put on the plans that they previously had. So, yeah, we'll just leave it with In this portfolio, the biggest thing is generating as much free cash flow as possible to cover the RMD for as long as possible. So anyway, any comments, thoughts, feel free to subscribe, and thanks for taking time to watch these videos. Let me know if there's anything that I can do to improve them or make them a little bit better. Thanks everyone, have a great day.